Good afternoon and welcome to our Nonprofit Accounting and Tax Update webinar. I'm Donella Wilson, Nonprofit Practice Leader at GHJ, and I will be moderating today's panel discussion. Joining me are my colleagues Liz Navarez, Yulia Mazeva, Amy Ibsen, Amber Coatney, and Brett Krall. Liz leads our nonprofit tax practice and is our tax expert today, along with Brett, while Yulia, Amy, and Amber are our technical experts on the accounting side. And full bios are available on our website and in the materials that you will be receiving after today's webinar, along with the recording. We're going to be covering a range of topics today, as noted in the agenda on the screen. And our goal is to both provide guidance and provoke discussion beyond today's webinar. If you have questions, please drop them in the Q&A together with your email address, and we will respond to them after the webinar. We have a full agenda today, so we are going to be responding to questions after the webinar. A key consideration in 2023 is navigating economic uncertainty and the impact of inflation. And in response to these challenges, nonprofits are pursuing operational efficiencies to reduce costs, such as innovative technologies that you'll hear a bit more about shortly. And nonprofits are also seeking ways to diversify revenue streams. And corporate donations are a revenue stream that many nonprofits acknowledge they need to tap into more. Apart from cash grants, corporations provide support through in-kind gifts, sponsorships, cause-related marketing, pro bono services, and workplace giving. And if you plan to pursue more corporate support in the form of in-kinds, then you will want to know how to record them and how to disclose them. So we are going to kick off, seeing as we're now a year or so into the new accounting standard for contributed non-financial assets. We're going to kick off with a question to Amy. Amy, while most nonprofit organizations listening in have likely already adopted the new accounting standard governing gifts in kind, or ASU 2020-07, can you provide a quick refresher on the standard?
Sure, Donella. This ASU was effective for fiscal years ending June 30th, 2022 and calendar years ending December 31st, 2022. And as a reminder, the purpose of this standard was to increase transparency by enhancing the presentation and disclosure of contributed non-financial assets, otherwise known as gifts in kind. We have some of the disclosure requirements and best practices listed on this slide, as well as an example of the tabular disclosure option that includes the required disclosures such as the description of donor restrictions and a description of the valuation techniques and inputs that are used to arrive at a fair value measure.
Thank you, Amy. And what are some of the lessons learned from implementation of this new standard?
Sure, and next slide. Now that we're about a year into adopting the standard for most organizations, there definitely have been some lessons learned. And we have a list of some of the most common errors and challenges that may have previously existed, but have definitely been highlighted as a result of adopting this new standard. In terms of recording volunteer time that does not meet the definition of GAAP, pro bono services, just as a reminder, must be performed by professionals with a specialized skill, must create or enhance a non-financial asset belonging to the organization, and the organization would otherwise have to purchase these services. Some organizations also realized that there were inconsistencies with the values that they were using for the same exact goods. So for example, there might be one category of goods that may be valued using thrift, and then identical goods that were used or that were valued using retail values. So consistency is important here. Relying on the donor's valuation and not retaining support for the valuation, especially come time for a financial statement audit, was also something that we've noted. And it's crucial that organizations don't place reliance on the donor's valuation and perform an internal assessment themselves. And not tracking gift in kinds through the year can also cause a completeness issue when it comes time to prepare disclosures and recording kinds. And making sure that program and development staff are providing timely information for financial reporting purposes is key here. And then other common issues that we've seen to wrap up relate to real estate and use of facilities, where in a rapidly changing real estate market, values are not necessarily being updated to reflect current real estate market values. And sometimes donated use of facilities may only be recorded for the first year when an organization is actually given multi-year use of facilities.
Thank you, Amy. And I think as we reflect on this slide, to me, an interesting takeaway is that while the standard really addressed enhanced disclosures and not valuation methodologies, most of the lessons learned really do relate to valuation. So I think that is really a key takeaway. And now turning to Liz on the tax side, how do these types of in-kinds show up on the Form 990? And, you know, while we're talking tax, what reminders, best practice reminders do you have for charitable gift receipting?
Thanks, Danella. In terms of the Form 990 reporting, non-cash assets are included as both revenue and expenses on the 990. You do have to remember that in-kind services are the only ones that are backed out of the Form 990 and not reflected. I often get the question as to what an organization needs to record on their charitable acknowledgement letters when they do receive these non-cash donations. And it is important to remember that they do not include the fair market value of the donated asset. It is actually up to the donor to determine the fair market value for their own charitable deduction purposes. The nonprofit should only be including a description and quantity of the item being donated to the organization. If the organization receives an item that is valued of over $5,000, the donor should be providing the Form 8283 to the nonprofit organization for signature. Along with this form, a required appraisal should be included that includes support for the value being claimed. This appraisal can be used by the nonprofit organization for financial purposes and recording of that fair market value. A form that's often forgotten is actually the Form 8282, and this form needs to be filed by the organization once you dispose of donated property within a 3-year period. Sometimes donors, when they are donating assets valued of more than $5,000, they want to put a restriction in which the organization needs to hold it for at least a 3-year period. The reason being is, you know, they may not want this form filed with Internal Revenue Service, because if there is a large discrepancy in terms of what they claim the fair market value was on their Form 8283 to what that Form 8282 reported at actually being sold, then it may cause a potential red flag. But it's still the responsibility of the organization to ensure that this form is filed once you dispose of that property within this time frame.
Thanks, Liz. And staying with in-kind contributions for the moment, specifically contributed facility usage, which is not reflected on the Form 990, I'm going to turn to Amber. Can you remind us what is in scope for ASC 842, the new lease standard, and how it impacts nonprofits that receive donated facility usage or use of facilities at below market rates?
Sure. Thank you, Danella. ASC 842 is effective for fiscal years ending December 31st, 2022 and June 30, 2023. It requires organizations to assess both finance and operating leases and record a right of use asset and liability for those leases with terms longer than 12 months. Many nonprofits have certain leasing arrangements that will require additional considerations. Donated facility usage, for example. ASC 842 defines leases as those that convey a right to control the use of property in exchange for consideration. In the case of facilities donated free of charge, as there is no consideration exchange, this transaction would fall outside of the scope of ASC 842 and instead would be treated as contribution revenue and recorded using the market value of lease payment. If that lease term covers multiple years, as Amy previously mentioned, the full value should be recorded and discounted to present value. Another common arrangement is facilities donated at below market rent. As there is both an exchange and contribution element to this arrangement, it would fall within the scope of both ASC 842 and ASU 2020-07. Under ASC 842, a lease liability equal to the present value of lease payments would be recorded, and under ASU 2020-07, the difference between the fair market value of the rent and those lease payments would be recorded as contribution revenue.
Well, if ever there was motivation to encourage your donor to give it to you free of charge and not at a reduced below market rent, I think there's one right there. Now you've got both considerations, in scope and out of scope, for two components. That's challenging. And in the interest of dealing with challenges, what are some of the practical expedients that nonprofits can take advantage of to make the implementation of this rather complex standard a bit easier?
Sure. So to assist with implementation, FASB has allowed organizations to elect certain practical expedients with the intent to relieve some of the burden in determining and calculating applicable leases. The first of these is the expedients package, in which the following three expedients must be elected together or not at all. This package allows an organization not to reassess whether any expired or existing contracts are leases or contain leases, the lease classification for any expired or existing leases, or the previously recorded initial direct cost for any existing leases. One practical expedient that many of our clients have appreciated is related to short-term leases, which allows an organization to make a policy election to not apply the requirements of under ASC 842 to those class of assets with terms of 12 months or less. FASB also allows an expedient in the election of the discount rate, which offers an organization an alternative to use their risk-free interest rate in lieu of calculating their incremental borrowing rate when the discount rate implicit in the lease is not readily available or determinable. FASB offered further clarification related to this expedient in permitting this discount rate to be applied by class of assets rather than as an entity-wide election. And lastly, an expedient is offered to combine lease and non-lease components, such as common area maintenance fees or other related services, and account for them as one combined lease component. The alternative would require allocating the costs across each component, which can prove time-consuming and difficult when determining standalone prices.
Thanks, Amber. And I know you've had the pleasure of working with many clients who've had to adopt the standard either early or obviously it's effective this year. So you've worked with a number of clients, and I think pretty much all of them have taken advantage of the practical expedience. So this is a very important slide. Any other reminders or tips that you have based on some of the implementation work that you've done?
Sure. So one reminder is that deferred rent does not exist under ASC 842. So any prior year balances related to deferred rent will need to be eliminated against the right of use asset during implementation. Similarly, lease incentives such as the tenant improvement allowance will also need to be eliminated against the right of use asset, and moving forward will be amortized against that right of use asset.
Thank you, Amber. And now, for those of you who are keen to get your hour of CPE, the first of 3 polling questions is coming up on the screen, and you'll have to answer all 3 to get your hour of CPE. So that will stay up for a little bit as we continue on with the webinar. So to complete our revenue recognition update, I'd now like to turn over to Yulia to discuss some commonly missed considerations. Yulia, timing is everything. What do we need to watch out for when a grant to be used in a new fiscal year is received in the last month of the previous fiscal year, right at the end of the fiscal year?
Thank you, Danella. So this situation is fairly common. In this instance, a nonprofit may want to defer that revenue recognition to the next fiscal year when the related activity under the grant occurs. Unfortunately or fortunately, nonprofit revenue recognition standards really prescribe that unconditional contributions should be recognized in the period when they are received, and there is no matching principle to follow. So the first thing to do is to read through that grant agreement very carefully to see whether there are any barriers that might preclude that recognition and the right of return or release for the donor. So having both of the barriers and the right of return would deem the grant conditional, in which case the revenue would not be recognized until those conditions are met. And on the slide here, we have some common examples of those barriers on the left-hand slide in the table. And we also have some examples of common grant provisions that would not constitute barriers. And I want to really emphasize that just having the grant period specified in the grant by itself would not make it a donor condition. It's more of a donor restriction to the time period. However, the grant agreement, as you read through it, may include other items that would point to conditional treatment, such as having to incur qualifying expenses under or in compliance with uniform guidance.
Thank you, Yulia. Then what happens when, well, this also occasionally happens, when a grant is so large as to be distorting to the financial statements, and that often causes consternation, particularly with the board?
Absolutely. So it's really important to be transparent about the impact this will have on the financial statements to the board and other stakeholders. Most likely, as a result of recognizing that grant revenue in the year received, there will be a significant surplus, followed by a year where you might have a net loss in a statement of activities. And assuming the grant is restricted for a specific activity or program or time period, that grant income will actually be included in the with donor restrictions column on the statement of activities. And that's where the net loss will show up as well the following year. So management should consider explaining to the board that on the statement of activities, it's the without donor restrictions column that represents the operating activity of the organization. And it really represents should be the focus of evaluating the organization's financial performance. The material swings in the with donor restrictions column really represent the mechanics of nonprofit revenue recognition or the restricted gifts that have been received for future purposes. And additionally, management may want to consider including expanded disclosures in the notes to the financial statements about the grant if it's so significant that it's really been distorting the statement of activities. And so those disclosures would then be readily available to external donors and grant makers.
Thanks, Yulia. And of course, you can always go back and have conversations with your donor. You can rework grant agreements or even upfront have conversations with how they might impact the reporting. But at the end of the day, right, an unconditional grant is better than a conditional grant for an organization, and general operating support is better than a restricted grant most times. So don't let the recording really get in the way of what's always in the best interests of the organization. And I see up on the screen, we have our donor advised fund slide, which is actually my next question for Yulia. Just some cautions around when a donation is received from a donor advised fund.
Yeah, so donor-advised funds have really gained in popularity in the recent years due to the ease and flexibility they afford the donors. And just by way of background, if someone is not familiar what that is, a donor-advised fund is a separately established fund within a sponsoring organization that organization then manages and operates. And that organization actually retains the legal title over the funds that have been contributed into that fund. The donor may still retain the right to advise the organization on where to spend those funds, on whom to award the grants to, but it's really the sponsoring organization that makes that final determination. And so sometimes our nonprofits will receive a letter saying something like, we will recommend a grant from our donor advised fund. When you see that language or similar language, it's really not meant to be a binding pledge. It's not considered a legally binding pledge because the donor, even though they will recommend the grants, they don't have the legal control. It's only when the donor advised fund awards that grant is when the nonprofit is able to recognize that revenue.
Thanks, Yulia. And actually another caution on that note is sometimes we will see an existing pledge being fulfilled by a contribution from a donor advised fund. And it may not always be clear which pledge that contribution from the donor advised fund is fulfilling. So making sure that when you do receive contributions from donor advised funds, if you need to probe a little bit to find out where the recommendation came from or if there's any other intention behind that. Otherwise, you do run the risk, which we do occasionally see, of double counting that revenue. Now, seeing as we're speaking donor advised funds, let's go over to Liz, because from time to time we hear about legislation being introduced to alter the way donor advised funds operate and distribute funds. Has any of that legislation passed, and what is the current status?
That's correct, Danella. What currently out there is the Biden budget proposal, in which actually changes the way a private foundation transfers funds to a donor advised fund. In this proposal, it will actually require the DAF to redistribute the funds to a public charity within 1 year. Currently, there's no requirement for the DAF to redistribute the funds. The foundation can transfer funds to a DAF, and it will count towards their 5% minimum distribution. If this does pass, then that DAF will need to go ahead and redistribute the funds within that 1 year time period. There's also a change in the way compensation payments to disqualified individuals will be treated. Currently, general expenses and administrative expenses, including compensation, actually count towards that 5% minimum distribution. In the proposal, this will actually disallow these payments to be counted towards the minimum distribution, and it will really impact family foundations that tend to pay individuals that sit on the board compensation, which it is allowed for necessary services that they provide, but it will not count towards that 5%. So it's trying to limit how much is being paid to these individuals. And that's what's currently out there. It has not passed, but it is in the Biden proposal. Another proposal that was out there last year, you may recall I mentioned the ACE Act, in which also was trying to regulate the way DAFs are ran. It was trying to limit how many years the DAF could be used for and when the contribution will be counted, but it actually has not moved along. And I actually want to give some data in regards to how DAFs are currently operated. Based on the annual National Philanthropic Trust DAF report that came out in 2022, it used information from Form 990s, the 2021, in which it calculated that DAFs had a high payout rate of 27.3, which is well above the PF requirement of that 5% distribution. In 2021, we saw about 72 billion contributions go into DAF, and about 45 million were actually paid out in grants to the community. So there was some worries during the COVID period in which individuals saw that there was billions of dollars sitting in these DAFs, and obviously organizations were needing funds during this time period, and they brought out the ACE Act to try to get these funds out there. But based on the data, we are seeing these high payout rates. The California Attorney General report issued a report based on 35 California organizations, 22 of them were national, and 57% of the DAFs had a ratio exceeding 50%. Again, very high payout rates for these DAFs, meaning they see the concern out there for communities, the need for funding, and they are redistributing these funds out there. So I think that's why there hasn't been as much movement on the ACE Act that was previously in legislation last year.
Thanks, Liz. Yes, that's very reassuring. I certainly like those annual payout rates, as I'm sure others on the call do. So switching from those commonly missed considerations around revenue recognition, we're going to switch over now to expense recognition and a couple of areas that frequently cause confusion. So Yulia, when is it appropriate to accrue for legal contingencies?
Legal contingencies are a form of a loss contingency, so they follow that accounting recognition model. So for a liability to be accrued under the loss contingency model, it would be accrued when the loss is probable and the amount can be reasonably estimated. In relation specifically to legal liabilities, it's important to consider when the underlying cause for that claim, whether actual potential occurred. So for the liability to be accrued in the current fiscal year, that underlying cause needs to have occurred within the same fiscal year or before, but not after. And so sometimes this catches people off guard, because this is true even if management was not aware of the claim until after year end, or if the claim was not even filed until after year end. As long as that underlying cause occurred within that fiscal year, that's when the accrual needs to happen if the loss is probable and the amount can be estimated. And Another point to consider is that sometimes there is a settlement in the work, sometimes the amount is known. And so that amount needs to be considered when you make the liability accrual. And again, this is also true, even if that settlement has not been reached until after year end. And as long as the financial statements have not been issued, that's when you need to consider all these facts. So to give you an example, we had a client, working through a legal claim, and they knew the claim was filed, they knew all the circumstances, and just as we were about to issue the financial statements, a settlement was finally negotiated. Before that, there was no estimate of the amount because it was such a wide range that there was no. In fact, it wasn't even probable whether or not the loss would be incurred. And then finally, just as we were going into the issuance of the financial statement, that settlement amount was clarified and agreed upon, and they had to go back and record that claim liability.
Thanks, Julia. And then also just a reminder, when you're classifying your legal settlements and legal fees, those fall under management in general in your functional expense categories. All right. Now, thinking about the many transitions that are happening in the labor market at the moment, another consideration that comes up quite a bit is how do you treat severance payments?
This topic is especially fascinating to me because depending on a set of facts and circumstances, you might have different accounting. And so this table on the slide represents all the different severance arrangements that might exist, and it doesn't even represent a whole entirety of them, but these are just the most common examples. And so, for example, if you look at the bottom left corner of the chart, this represents a set of facts when an entity might have an established ongoing severance or benefit payout plan for post-employment benefit payouts, and these benefits would vest or accumulate. So accrual for such benefits would actually happen as they are earned when the employee is still serving for the company. On the other hand, the bottom right corner of the slide really represents a situation when there is not an ongoing plan and there is a one-time special termination benefit being negotiated. And so accrual for that actually happens when management identifies or commits to a plan, identifies the employees and communicates the plan to those employees or employee. And so following that, if there is no further service required from an employee, then that liability is accrued right at that point for the entire amount of severance. However, if the employee is still required to work for a certain period after that communication has been made, the expense is accrued ratably over that service period. And so again, to give you another example, we had an organization we were working with, and they had a severance agreement with one of their employees, and to provide for a proper transition to the next individual, they asked that employee to continue working for a period of 4 to 5 months, and that period spanned 2 fiscal years. And so in the first fiscal year, when that agreement was actually signed, they only accrued the portion of the severance payout that related to that service period.
Thanks, Julia. So yes, this is a slide you're going to want to keep handy so that you can think about the different options. Liz, on the tax side, what reporting considerations do you have to share?
I do want to highlight that severance packages are actually required to be reported on the Form 990 if the individual is a top management individual or highly compensated individual. There's actually a specific question that asks whether severance payments have been made, and we do need to disclose the name and amount. In terms of reporting the compensation, ensuring that you're looking at the roles and responsibilities of the individuals. Oftentimes, organizations would pay the severance within the W-2, but then once the individual is still working, they want to switch them to a 1099 individual. And this is definitely a red flag for the IRS. Whenever they see both a W-2 and a 1099 being issued for the same individual, it does cause that red flag for them. So looking at those qualifications, those roles, how much time are they serving for the organization, to ensure whether they are in fact still a W-2 employee or whether they do qualify as that independent contractor. So ensuring that you're looking at that very carefully.
Good advice there, Liz. And before we wrap up on the accounting reminders portion of this webinar, Yulia, what can you tell us about the new accounting standard, which is a bit of a mouthful, but it's known as the current expected credit loss standard, and how it might impact nonprofits?
Sure, Danila. So the new current expected credit loss model will be effective for most nonprofits for fiscal years beginning after December 15, 2022. So that is your calendar 2023 year end or fiscal year 2024. And just like the name suggests, it introduces the current expected loss model for recognition of credit losses. So currently, the way credit losses are recognized, it's based on what's been incurred on the knowledge of historical knowledge of credit losses. But this new standard requires entities to estimate credit losses expected over the contractual life of a financial asset. Thankfully, we have a table here, what's in scope and out of scope. And thankfully, assets carried at fair value, such as pledges receivable, your investments at fair value, those are out of scope of the standard. However, accounts receivable from exchange transactions, such as, for example, patient service revenues, and I know there are a few clinics here on the line listening to this webinar right now, so that would apply to those balances specifically, and then programmatic investments would fall within the scope of the standard as well.
Thank you, Yulia. One can only hope that the FASB pauses for a little bit on all these standards, right? They seem to come up with something all the time. Okay, so I think we're going to have our second polling question coming up on the screen. So for those of you who are looking for your CPE, just a reminder, you need to answer all three, and this is the second one. But while it's up on the screen, we will continue on. And I'm actually going back to Liz, who's fresh from the Georgetown Conference for Tax-Exempt Organizations, for an update from the IRS.
Thanks, Danila. And if we could go on to the next slide, please. In terms of the priority guidance plan that was issued by the tax exempt unit, donor advised funds is on top of their list. They are still trying to issue final regulations for donor advised funds. This has actually been on the priority guidance list for some time on the IRS, but they have not gotten to it just because several other factors have come into place that they have not been able to really issue these regulations, but it's on there again. They're trying to issue regulations in terms of, what is considered a taxable expenditure for donor advised funds, what are potential excise taxes that would be in place for those sponsoring organizations and those fund management fees, what are some prohibited benefits between a donor advised fund and the donor, some excess benefit transactions, as well as guidance regarding the public support computation. As of now, when the donor advised fund issues a contribution to a public charity, the public charity actually lists the DAF, not the organization managing the DAF, as a donor, not the donor who is advising it. So there is guidance that they are looking to treat the actual donor, so more of a pass-through, as the individual donating. So this will highly impact the public support computation because most of the time these DAFs are ran through public charities. And when a public charity donates to another public charity, it's just considered public support and it doesn't actually hinder their public support percentage. But depending on how these final regulations go, there may be a big change in terms of that disclosure and how that public support is being impacted by these DAFs. Another item on the priority guidance plan are regulations in terms of allocating expenses when an organization has unrelated business income. Right now, there's not that much guidance in terms of how organizations should be allocating expenses. You have to really just determine your own methodology and remain consistent with that. So the IRS is looking to issue some more guidance as to how organizations should be allocating these expenses. And lastly, there is guidance, or hopefully will be guidance, in regards to private foundations investing in a partnership in which a disqualified person is also a partner. And the reason being is disqualified individuals can potentially leverage some of the foundation's assets in order to invest into partnerships. So sometimes there's limits and to how much capital needs to be contributed into a partnership. So they would use the foundation's assets. So then the disqualified individual can also go into that same partnership. So again, they're looking to issue guidance as to what could potentially be considered an excess benefit for that disqualified individual. And next on the tax exempt unit priorities list is a hiring initiative. So the IRS has seen new funding going in, and with this new funding, they are looking to expand the tax exempt unit and expand their workforce. So we'll potentially see an increase in audits based on this new workforce. But in another area that's actually also helping the IRS with examinations is their expanded use of data, machine learning, AI, and algorithms to select organizations for audit. So they're running all of these through the 990s that are now required to be e-filed. So this e-file requirement is actually helping them in selecting these organizations because they're able to run these algorithms a lot easier and smoother now that everything is being e-filed. And personally, I have seen an uptick in organizations being selected for examination because of these algorithms. So it's something to remember to always look through your Form 990, look for any potential red flags that might trigger these examinations. They also disclosed their 2023 accomplishments in terms of examinations, and they did go ahead and audit about 1,300 organizations. And out of that, there was a 75% change rate, meaning they discovered maybe individuals' compensation wasn't reported correctly, program services, or they found something in their 990 or their activities that did need a changing, and that was 75% of that time. And if we could go on to the next slide. Another tax update is the solar and energy credits that are now available to nonprofit organizations. In the past, nonprofits weren't able to take advantage of this because some of these tax credits were offset against income tax. And as nonprofits don't pay income tax, they weren't eligible. But out of the Inflation Reduction Act, nonprofits are now allowed a refundable credit for some of these energy efficiencies, one being a solar credit, where you can get reimbursed up to 30% of the cost for solar. And if your organization is actually located in an area that's considered a low income community, you may get an additional 20%. So up to 50% of the cost reimbursed to the organization. There's also a reimbursable credit for an EV charging station if that is added on site of the organization. Or if you're looking to add additional vehicles that are EV vehicles, there's also a 30% credit on that. There are certain restrictions in terms of the manufacturer and different nuances. So it's important to ensure that you check which vehicles are allowed before you go out there and purchase the vehicle to claim the credit. These credits will be claimed on the Form 990T. Although organizations don't have unrelated business income, you will need to use this form in order to claim that refundable credit. Lastly, there is an energy efficiency pilot program grant that is ran through the Department of Energy. This is actually starting this year in 2023, in which nonprofits are eligible to receive up to $200,000 in grants if they are looking to add new HVAC units, windows, roofing, anything that's energy efficient improvements. So again, something I encourage you all to look into.
Thank you, Liz. And I know many of our clients have been very intrigued by these credits and grants, and you'll want to be looking into those into a little bit more detail, and so as not to miss out if you're eligible for those. So we're going to stay with tax for a little bit longer. And Brett, can you give us a quick reminder of what the employee retention credit is, and specifically how to assess eligibility and how to claim?
Thanks, Daniela. So the Employee Retention Credit, or ERC, as many of you may know, was introduced as part of the CARES Act in early 2020. It's been subsequently modified by a number of other COVID-related pieces of legislation. And the original intent here was to encourage employers to maintain employment levels, or at the very least, health benefits during the pandemic. So what the ERC is a refundable payroll tax credit for 2020 and 2021 quarters that's claimed on the quarterly filed payroll tax returns. The ERC is generally available for all 2020 quarters and available for most organizations for the first through third quarters of 2021 and is available during the fourth quarter of 2021 in a very limited circumstance. Since presumably the payroll tax returns for all of these quarters have already been filed, the mechanism through which we claim the credit now is by going back and filing amended payroll tax returns. The credit's available for for-profit and nonprofit organizations alike. In fact, some of the nonprofit organizations that we've worked with have seen some of the largest refunds, many of them being 7 figures plus. We've worked with a number of different kinds of organizations, from foundations, community service organizations, arts and culture, and museums. So it really runs the gamut. Now, you can qualify for the ERC in one of two ways, and I want to highlight that you only need to meet one criteria to qualify. The first way is if you experience either a full or a partial suspension during a calendar quarter due to a governmental order related to COVID-19. Now, that's a bit of a mouthful, and all it means is that if there's some sort of governmental body that issues an order that causes you to change the way that you do your business or stop operating your business in some way, it's possible that you may be partially suspended. Now, as you can imagine, suspension is a very facts and circumstances oriented test. So documentation of the qualifying suspensions, qualifying activities is going to be key. One of the other things that's important to highlight about the partial suspension qualification is that only wages paid during the period of suspension are potentially eligible. So you don't automatically qualify for the entire quarter. The other way that you can qualify for ERC is if you have a substantial decline in gross receipts in a calendar quarter as compared to that same quarter of 2019. This is the preferred method to qualify because the qualification is much more black and white. It's much more straightforward. And contrary to the partial suspension qualification, if you qualify based on a substantial decline in gross receipts, you qualify for the entire quarter. So all wages paid in the quarter are potentially eligible. Now, depending on whether we're talking about a 2020 or a 2021 quarter, the qualification rules are the same, but some of the definitions are going to be slightly different. For example, to qualify based on a substantial decline in gross receipts for a 2020 quarter, you need to see a decline of more than 50% in one of those quarters as compared to that same quarter of 2019. For 2021, to meet the substantial decline test, you only need to see a decline of more than 20% in a calendar quarter as compared to that same quarter of 2019. Quite a big difference. Now, getting into the credit amount, again, it depends on whether we're talking about a 2020 or a 2021 quarter. So in both instances, the credit is based on what we're defining as qualified wages. Qualified wages generally includes gross wages, employer paid healthcare expenses, and both of those amounts include amounts that are paid with any operating grants that are received by an organization. Notably, qualified wages exclude any amounts that are paid with forgiven PPP funds. Now, another caveat here to qualified wages is the large employer threshold, which again is different depending on whether we're talking about 2020 or 2021. For 2020, that threshold is 100 full-time employees in 2019. And for 2021, that threshold is 500 full-time employees for 2019. And the reason this makes a difference is if you are considered to be a large employer, only wages paid to employees who are not providing services to the organization are potentially eligible as qualified wages. But if you fall under those thresholds, then all wages paid to all employees are potentially eligible for the ERC. Now, for 2020, the credit is taken against up to $10,000 in qualified wages per employee for the entire year 2020. And the credit is available at 50% of those qualified wages. So a potential maximum of $5,000 per employee for the entire year of 2020. In 2021, the credit value was significantly expanded, and we still have the same $10,000 per employee of qualified wages, but now we get that $10,000 maximum on a quarterly basis. As I previously mentioned, most organizations are eligible for the first 3 quarters of 2019, so potentially $30,000 of eligible wages for 2021. The credit is 70% of those qualified wages, so potentially $7,000 per employee per quarter, or a total maximum of $21,000 per employee for the entire year of 2021.
And Brett, initially with the rules as they were under 2020 versus what they became under 2021, we saw many non-profit organizations and many for-profit organizations being slower to really explore their eligibility and take advantage of this credit. Of course, now we've seen some of the large payments and many more organizations are seeking to claim the employee retention credit. But we're probably coming up against some deadlines now. So what are the deadlines for amending?
So the amendments for all 2020 quarters are going to be due April 15th of 2024. And the amendments for all 2021 quarters are going to be due April 15th of 2025.
Okay, so great. So we've still got a bit of time. But on the other hand, the sooner you get it in, the sooner you get that cash. And Brett, can you give us a little update on where the IRS is with these payments for ERCs?
Yeah, so unfortunately, the IRS processing time on these amended payroll returns is woefully slow. Claims that are relatively smaller, under the $200,000 threshold or so, may typically get processed in 4 to 8 months. Claims that exceed that amount, we're seeing anywhere from 18 to 24 plus months for processing. Important to note is that there is no limited pool of funds. Once your returns are filed, you are in line, you're in the queue, and it's just a matter of waiting.
Oh, well, that's reassuring at least. But yes, the sooner you get into that line, the better. But Brett, what about any cautions that you may have for claiming the ERC?
So right now in the industry, unfortunately, there are a number of bad actors in this space. In fact, it's to the extent that the IRS has added the ERC to its dirty dozen list as an area of interest and an area of observation. Many of these sort of fly-by-night operations work off of a contingency and really have pretty low thresholds as far as how they qualify folks, and really are motivated to push boundaries, for their own selfish gain. So I would encourage folks to use a trusted advisor when you're substantiating and calculating ERC amounts, particularly if you are seeking to qualify based on a partial suspension of operations. Further, one of the most important things is to ask any providers what their stance is and what kind of support they offer in the event of an audit.
Thanks, Brett. Well, yes, documentation is music to our auditor ears. And speaking of auditors, let me turn over to Yulia to address the presentation of the employee retention credit in the financial statements.
Sure, Daniela. So from the accounting standpoint, employee retention credits are considered non-reciprocal conditional contributions, which might sound counterintuitive, but there it is. There are 3 main conditions to be satisfied to claim net revenue. First one is incurring qualifying expenses. Secondly, you must meet the eligibility requirements, as Brett just went over. And thirdly, you need to file that amended tax return. And so once you hit all 3, you can recognize that revenue. A lot of entities, or what we at least see with our clients, are hesitant to recognize that revenue until they actually get a payment from the IRS. So I want to emphasize the payment timing is irrelevant for purposes of revenue recognition for this credit. It's really when you satisfy those 3 conditions. And we have a fact pattern here on the slide as well, and really just goes over the same scenario where when you actually satisfy all those 3 conditions is when you recognize that revenue, and when the payment comes in, that's just reducing your account receivable and debiting cash.
Thanks, Julia. Now back to Liz for the tax presentation on the Form 990.
In terms of the Form 990 reporting, we will stay consistent to the way the audited financials record the revenue. So we will pick up the revenue at the same time to stay consistent. So whenever that is recorded, we will report it on the Form 990.
Thanks, Liz. And now I think we have our third polling question about to come up on the screen to get your CPE. But you won't want to just jump off this webinar now that you've got your 3 polling questions answered, because taking us to the end of our webinar, we have Amy up next going to speak a little bit about technology. When we think about reimagining how people, processes, and technology work together and how they can increase efficiencies and reduce costs, that's obviously music to our ears. And I did see one of the answers to the polling questions did indicate that investing in technology was a top priority in 2023. So how good that we have Amy closing us out, talking a little bit about how with the rapid digital transformation that we're dealing with, organizations considering using artificial intelligence in their processes. We're going to ask Amy to speak to a little bit about those recommendations that she has.
Sure, thanks, Danella. And I'm sure everyone on the webinar has probably been hearing a lot about artificial intelligence in the news, and you may even be considering utilizing AI tools at your nonprofit organization. And for those of you who may not be familiar, I'd like to provide an explanation, different use cases, as well as words of caution on using these chatbots, as they tend to be the most common and widely used AI tools. AI chatbots such as ChatGPT, Bing, and Bard are powered by what's called large language models, which are GPT-4 and Lambda. And they are trained on large amounts of text data and use advanced algorithms to learn the patterns and structures of language. They're capable of generating coherent human-like responses when they're prompted. And large language models are types of deep learning systems, which are a subset of machine learning, which fall under the overarching umbrella of AI. And I just want to caveat that these are very recent developments, and these tools are rapidly changing, as well as their capabilities. So as an example, OpenAI released ChatGPT publicly just in November 2022, and Bing and Bard were released in February 2023. I also wanted to point out that we've added a link on this slide to research that OpenAI has published on large language models and AI that I've personally found interesting. And it's a good resource to understand the current capabilities and ever-changing capabilities of these models. And then on the next slide, we've added a few use cases that nonprofits might consider and that could potentially help with efficiency and saving your employees' time. So as an example, the bots can help with potentially brainstorming event ideas or programmatic ideas. They can also help with not only drafting, but also improving existing itineraries, donor emails, meeting agendas that are input into the bots. They can also be used to help write and also to check or troubleshoot problematic formulas in Excel. And they can also help to write and create or double check different types of code. And more organizations are utilizing these large language model platforms and building out customizations to automate repetitive tasks. On the next slide, we have a few words of caution in terms of using these bots. And it's important to consider implementing an organizational policy that documents and addresses some of these concerns. And if we could please move to the next slide. So you may want to consider adopting a policy in terms of not inputting sensitive information such as donor, employee, and grantee data. In general, this type of information should not be input into these bots. Also, sometimes the chatbots sometimes don't tell you that they don't actually know the answer to a question, and it may generate a response that sounds good and sounds like it could be realistic. But some of the bots do automatically provide links to sources, and some do not. So it's important to verify any research that you perform, especially accounting and tax research. It's also important to not utilize these tools as search engines and make sure that you're asking really specific questions and giving specific parameters, including what type of information outputs you're looking for, or you might get a vague and unhelpful answer and it will just be a waste of your time. The free ChatGPT accounts are limited at knowing events past the fall of 2021. So there is a limitation there, but Bing and Bard actually do currently access live web sources. And of course, it's always important to credit sources and to avoid potential plagiarism when utilizing outputs from these bots. And this has become an issue that, as an example, universities are addressing currently with their students and developing policies around. And finally, on the next slide, we have some considerations if you're looking to adopt software that has AI capabilities, or you're looking to create a custom AI tool for your organization. And these are topics and questions that you may want to explore with really any technology vendor, but just make sure to look at it from a different lens if you're considering the use of AI.
Thank you, Amy. And Amy, as is probably no surprise to those on the call, is one of our technology leaders at GHJ. And this was a little teaser for a technology webinar that Amy is going to host later this fall. So our time is now up. A big thank you to our panelists, Amy, Liz, Julia, Brett, Amber. And for those of you who raised questions in the Q&A, we will respond to them in the email that will go out after this webinar together with the recording. Thank you very much for joining us and enjoy the rest of your afternoon.